Welcome to Trade Savvy Academy, where we empower you to build wealth with confidence. Buckle up because today I'm diving into 5 incredible dividend stocks I've recently started buying, and I'm thrilled to share why they're must-haves for your portfolio. Each one is trading well below its all-time high, offering a golden opportunity to snag value, lock in juicy dividend yields, and position yourself for future gains. Stick with me to the end as we unpack the latest data, my reasons for investing, their yields, recent returns, and what's on the horizon. Whether you're chasing income or growth, these picks could be game changers. So let's dive in and get savvy with your investments. Dividend stocks are the backbone of a smart, income-driven portfolio, delivering steady cash flow while offering potential for capital appreciation. Right now, with markets fluctuating and economic uncertainty lingering, stocks trading below their recent highs can signal undervaluation, a perfect entry point for disciplined investors. The 5 stocks I'm buying combine strong fundamentals, attractive yields, and growth potential. By adding small portions now, you can build positions gradually, minimizing risk while capitalizing on their discounted prices. Let's break down each stock, using the latest data as of June 16, 2025, to explore why I'm investing, their dividend yields, recent performance, and what to expect moving forward. I'm kicking things off with Lowe's, ticker symbol LOW, a titan in the home improvement sector that's caught my eye at its current price of $217.94, well below its 52-week high of $287.01. With a dividend yield of 2.21%, based on a forward dividend of $4.80, Lowe's offers a solid income stream. In its Q4 2024 earnings, reported February 26, 2025, Lowe's posted net earnings of $1.1 billion, with adjusted diluted EPS of 1.93 and comparable sales up 0.2%, driven by professional sales, online growth, and hurricane rebuilding demand. For 2025, the company projects sales of $83.5 to $84.5 billion, with earnings per share of 12.15 to 12.40, reflecting confidence in its total home strategy. I'm buying because Lowe's dominates a resilient market, benefits from steady renovation demand, and returned $1.4 billion to shareholders via repurchases and $650 million in dividends last quarter. Trading at a discount, now's the time to start nibbling at this stock for long-term growth and income. Next up is Starbucks, SBX, trading at $94.42, a steal compared to its 52-week high of $117.46, with a dividend yield of 2.62% based on a $2.44 forward dividend. Despite a bumpy Q2 FY25, with revenues up 2% to $8.8 billion, but GAAP EPS down 50% to 0.34, Starbucks is leaning into its Back to Starbucks turnaround plan under new CEO Brian Niccol. Global comparable store sales dipped 1%, with North America down 1% and China flat. But the company's focus on operational efficiency and customer loyalty through its rewards program keeps me optimistic. Starbucks suspended 2025 guidance to prioritize stabilization, but its 0.61 quarterly dividend, payable May 30, 2025, signals commitment to shareholders. I'm investing because of Starbucks' global brand power and potential for recovery, making it a compelling buy at this price for patient investors seeking growth and income. If you're finding value in this video, please don't forget to support my channel by liking and subscribing. Also, for my free live stock market trades, don't forget to follow me on my X account, displayed on the screen. Moving on, Target, TGT, is another gem I'm adding, trading at $96.61. Far below its 52-week high of $167.40, and boasting a hefty 4.64% dividend yield with a $1.14 quarterly dividend, up 1.8% from last quarter. In Q4 2024, reported March 4, 2025, Target delivered 1.5% comparable sales growth, with digital sales soaring 8.7% and same-day delivery via Target Circle 360 jumping over 25%. Full year 2024 EPS hit $8.86, and cost savings topped $2 billion, showcasing operational strength. For 2025, Target expects 1% net sales growth, with EPS of $8.80 to $9.80, though Q1 may face consumer and tariff pressures. I'm buying because Target's focus on affordability, digital innovation, and store experience positions it for resilience in retail. At this discounted price, its high yield and growth potential make it a no-brainer for income-focused portfolios. The Kraft Heinz Company, KHC, a high-yield staple. Next up, Kraft Heinz, KHC, is a standout for income seekers, trading at $26.01, well below its 52-week high of $36.53, with an eye-popping 7.69% dividend yield based on a $2 trailing dividend. In 2024, reported February 11, 2025, net sales fell 3.0% to $25.8 billion, but adjusted EPS rose 2.7% to $3.06, and gross profit margin improved 120 basis points to 34.7%. Q4 saw adjusted EPS up 7.7% to 84 cents, with $2.7 billion returned to shareholders, including $1.9 billion in dividends. For 2025, Kraft Heinz projects flat to down 2.5% organic sales and EPS of $2.63 to $2.74, reflecting cautious growth. I'm investing because its iconic brands, like Kraft and Heinz, provide stability in the consumer staples sector, and that 7.69% yield is hard to beat for income investors. Trading at a discount, it's a great time to start building a position for steady cash flow. Healthpeak Properties Inc. DOC. Healthcare stability. Rounding out my picks is Healthpeak Properties, DOC, a healthcare real estate investment trust trading at $17.46, below its 52-week high of $23.26, with a 7.02% dividend yield based on an annualized $1.22 dividend. Q1 2025 results, reported April 23, 2025, showed net income of $0.06 per share, funds from operations as adjusted of $0.46, and 7.0% same-store net operating income growth across lab, outpatient medical, and CCRC portfolios. Healthpeak executed 1.2 million square feet of leases, with more in the pipeline, and repurchased 5.1 million shares for $94 million. For 2025, it forecasts funds from operations per share of $1.81 to $1.87 and 3.0% to 4.0% net operating income growth, supported by $2.8 billion in liquidity. I'm buying because healthcare real estate is a defensive sector with stable demand, and DOC's high yield and growth prospects make it ideal for income and stability. At this price, it's a smart addition for long-term investors. Future expectations and strategy. Looking ahead, these stocks offer diverse paths to value. Lowe's and Target are poised for steady growth in home improvement and retail, respectively, with 2025 projections showing modest sales increases and strong profitability. Starbucks' turnaround efforts could drive recovery, though patience is key as it navigates challenges. Kraft Heinz and Healthpeak, with their high yields, are anchors for income, with Kraft Heinz stabilizing its brands and Healthpeak capitalizing on healthcare demand. All are trading below recent highs, suggesting undervaluation, but future performance hinges on macroeconomic factors like consumer spending and interest rates. My strategy is to add small portions now, diversifying across these names to balance risk and reward, and monitor earnings for updates on execution and guidance. There you have it, Trade Savvy Academy fans. 5 dividend stocks with compelling yields, strong fundamentals, and discounted prices that scream opportunity. Lowe's, Starbucks, Target, Kraft Heinz, and Healthpeak Properties offer a mix of income and growth potential, perfect for building a resilient portfolio. Start small, stay disciplined, and keep learning with us as we navigate the markets together. Want to know what happens if you invest $10,000 into the top 3 dividend ETFs? Click on the video on the screen to find out.